Good day, everyone. Thanks for joining us, Market Chameleons, and anyone joining us for the first time for this special afternoon webinar with Dr. Jake Kilby, all the way from Dakar, Seneca, Africa. The man, the myth, the chameleon legend. There he is, the doctor. How you doing, doctor?
Yes, I'm really well, thanks.
It's great to have you on. I know you appeared on our morning show chat midweek, and I immediately zapped you an email hoping you would do a show because basically for the last year, for those who don't know, Jake, he's taken a role in Senegal where most of the time he's in the mining region where we can only imagine get in there, surviving the trip, surviving, I'm sure you stick out like a sore thumb in the bush.
Yeah,
and, I read stories, of kidnappings and abduction, and ransoms. And I'm like, oh my God, fingers crossed. Jake gets back safely, and here you are, and you're hopefully going home for a little bit. I hope.
Yeah, that's correct. I'm just finishing my stint, but you're spot on. It's a bit of a wild world out there, away from the States, and some really different stuff, and some really interesting stuff as well. But look, it's great to have been able to sit in on the pre-market the last couple of days, and then just put something together on the fly. It's been pretty cool as well.
Yeah, well, we look forward to it. But before we get started, let's I'll quickly go through the disclaimer. Neither Market Chameleon or Jake are registered investment advisors or broker dealers. Market Chameleon does not make recommendations as to particular securities or derivatives instruments. All this information you get is for informational purposes only. Market Chameleon is a research platform. It's up to you to do the research. That isn't in the disclaimer. I am just adding that. Dimitri says that all the time. And with that, we can get started, Jake. We have a bunch of people on Zoom. We also are streaming on YouTube Live. So I put the link to the Zoom on YouTube Live. You can ask your questions either by typing them in the chat, either in YouTube or on the Zoom. If you're on the Zoom, you can also raise your hands, and we will allow you to ask your question live. As long as you have a mic on your computer, you don't have to hit the video. You can come on and ask it live. We had Rodney, I think, was on this morning and ask a live question. It's always great when we get live participation from the community. With that, Jake, are we ready to go?
We're ready to rock and roll. Can you guys see my screen?
It's perfect. Equity valuation.
Okay, right. And just a quick one. Thanks again, Will and Dimitri, for having me on. It's great to be part of the Market Chameleon community, which I've actually been actively, I think, part of for the last couple of years and stuff. Just a bit of a spoiler alert for everybody here. This is going to be very, very basic equity valuation for newbies. I'm going to link it to some of the tools on the El Chameleano, the Market Chameleon platform, and then also show a little bit of the stuff that I do in terms of research and how I work and develop positions and stuff and trades, etc., on the Discord. But just linking it back into what Will said again, none of this is investment advice. This is how I do things, and it's up to you guys to manage your own risk and do your own research and so forth. But before then, so again, I just mentioned really a bit of an intro. For those who want some additional stuff, I'm going to give shouts out to the king, really, of equity evaluation in my mind, and that's Mr. Ashwath Damodaran. And he's got a lot of content online, and I've also put a lot of his content actually on my own Discord or on the Discord, because I think he's pretty much up there in terms of looking at, valuation in terms of valuations, discounting cash flows and the like. But without further ado, let's just get started. And it's really all about asset management. One of the things that people think is that, I'm just straight on the Market Chameleon, just dialing in positions and setting up plays and stuff. But the reality is that I'm probably actually spending pretty much most of my time doing research. I spend a lot of time reading professional journals. I read, financial information, financial newspapers and stuff like that. I even, dive onto webinars and stuff like that around professional organizations, etc. A few for you guys that you could, that you probably look into already. Things like, FRED, which is for the Federal Reserve. If you want all stats around, the state of the employment in the United States, you've got the Bureau of Labor and Statistics. And for those who are interested in the oil and gas industry, really, like I am, having spent considerable time working in global energy, you've got the American Petroleum Institute. So all in, guys, to give you a bit of an overview, I'm probably spending 80% of my time just doing research. So while I have the Chameleon open pretty much all the time, I'm also spending a lot of time looking through whether it's financial statements, listening to a speaker on a macro idea or whatever, and then trying to link that to a specific industry or a specific asset class, and then also trying to link that to potentially a specific company. After that, a lot of it is also all about risk management. I think Dimitri says this, and he says it really, really well. This is about risk management and, risk identification, and then weighing up those risks and seeing if the reward, outweighs that risk. That's why we've got Sharpe ratios and stuff like that. For you guys there, I've put a few which you may be familiar with. So modern portfolio theory, use value at risk. We've all probably heard of beta, right? So around systemic and non-systemic risk. We've definitely heard about delta because I've spoken about it in the derivative series, where we speak about directional risk on a portfolio of options. And then for those guys who do deal in a bit of fixed income, you've got duration. So I spent quite a bit of time on that, and then really just going, I've got the little diagrams. So I've got little beta and I've got delta just to make it kind of pretty. And then we've got valuation. And here's a bit of a screenshot from El Cameliano, where you've got a whole heap of comps, and we're going to go through these in a little bit, right? And you've got really the three classic classes, and I'll speak a little bit about them as well. So relative valuation, valuing a company or an enterprise around a comparable basket of companies. Absolute valuation, where we break down the sum of the company's parts. And then we've got free cash flow models, where we're going to discount, we're going to project into the future the potential cash flows of the company. And then, theory around time value of money, we're going to bring them down back to present day and then try and determine what the company's worth. And then we've got El Cameliano, which I use, like I said, all the time. I've been a subscriber for the last at least 3 years, and I use it actively. And this is all about execution and active risk management. So once we've done all the front end due diligence, all that work, it takes a lot of time and effort to do that. Then you've got the Market Chameleon, and this is really all about position selection, opening management of a position, closing, and then also the lessons learned, right? Because essentially Market Chameleon has a portfolio of data and statistics and historical info, and from there we can kind of figure out what happened with a position and how it behaved over a given period of time. So look, I'm going to send you guys back also to a webinar I did on top-down analysis, where we take a macro factor and we dial into a company. And I'm just going to do a little bit of a review on that. So essentially, when I'm thinking, first the thing I'm thinking about is a specific market, right? Am I speaking about equity? Am I thinking about fixed income, derivatives, and what are the risk premiums linked to those securities? Then you've got those markets, and you can think about more mature, very liquid markets. The United States has the most, I would say, probably the most liquid public securities markets. But you could also be bigger, more mature markets like the ones we find in Europe and also in Japan. You could dial into something a bit different, which could be pioneering illiquid emerging markets. We spoke about the BRICS, and I've got a little bit of an image there of BRICS. So Brazil, Russia, India, China, and South Africa is really, really important to gauge country risk, as we've seen with the conflict in Ukraine and Russia, and how that can change equity risk premiums, the value of securities, even the access and liquidity of a market due to geopolitical events, which is really, really tricky. And then I've got my pigs as well. You can see them down there on the bottom right-hand side. These are, we often put country risk or country or asset classes into little names and stuff like that. So we've got Portugal, Ireland, Greece, and Spain, which particularly suffered during the great financial crisis. So again, like I said, country risk is super important. And when you dial into or decide to take a position in a security, you need to know which country it's selling its products, where it's based, and what kind of risks it's exposed to in terms of inflationary pressures, monetary stability, what are the sovereign banks like in that country, employment rates, how is employment working, the demographics of the country. The demographics of Japan is completely different to the demographics, for example, of Nigeria, where Japan has one of the oldest populations in the world, if not the oldest, and Nigeria has a massively young country like Vietnam. Those demographics and that demographic pyramid is going to be extremely different, as are the consumers and stuff like that. The government we want to speak about, are we talking about a democracy like in the United States, or, for example, in India, or we're talking about an autocracy, et cetera, et cetera. These are all going to have an impact on equity risk premiums. And then we're speaking about the industry, right? So the competitive and regulatory environment, the business life cycle, and even government intervention in specific markets, whether it's defense or, special products such as drugs. We've got the FDA over in the United States for certain products. And those risks are something that you need to take into account as well when valuing equity. Then we've got a segment. And I'm from the oil and gas industry originally, so we speak about upstream, midstream, and downstream, and I'll give you guys a bit of an example. But we could also speak about, for example, the automotive industry. If you're taking a position in a tier one supplier, then the capital structure and the earnings profile is going to be completely different to original equipment manufacturer. So these are the things you need to take into account when you look at a position and you say, hey, that's cheap or that's expensive. You need to know where you're positioning in terms of market, country, et cetera, et cetera. And then we get down to the company. So really classic top-down analysis. And here, what company are we speaking about? Are we speaking about a market pioneer? Are we speaking about something which has been established for hundreds and hundreds of years, which is on decline? These also will have an impact on capital structure and on the earnings profile of the company, and hence the valuation as well. So I'll give you a little basic example. I've taken a little screenshot there from Trading Economics. So I choose the US equity market because we're on the El Cameleano, and probably a lot of the guests tonight are based in the United States. So we're speaking about a between $23 trillion economy, full employment, high inflation, 8.1%. The economy is rolling over, and we've got tightening monetary policy, as we heard from Jay Powell, who kind of sidestepped a bit, as you possibly noticed in the last Fed minutes, et cetera, or the Fed, post the interview. But all in all, the Fed has pretty much said they're going to go 75 basis points until essentially something in the economy breaks. So here we put it into asset classes. So if we're speaking about recessionary risk and high inflation, you're going to kind of look at things such as consumer defensive utilities or healthcare, because these have all these exposed traits or characteristics which are best suited for those kinds of environments. So for example, consumer defensive, also known as consumer staples. Well, whether the economy is good or not, you need to buy groceries, right? So you're going to buy food. And utilities is the same. Whether the economy is booming or not booming, you're going to pay your water bills, you're going to pay your electricity bills, et cetera, even if the market would become possibly more competitive with those inflationary pressures. And healthcare as well. The market may be booming, or the economy may be booming or not booming. We may be in a recession, but the reality is if you get sick, you're going to kind of have to look after yourself. So these are really plays which are best suited for that kind of environment we're in. Other ones, interest rate sensitive areas, probably the prime one is real estate, right? So speaking about mortgages, etc. Technology is quite sensitive to interest rates, particularly if you're discounting cash flows. So often technology companies have, very lofty forward earnings in terms of guidance. Well, if interest rates rise, then discounting those cash flows at a greater rate will make them, in terms of present value, less meaningful, and therefore that's what we see with technology. Interest rates go up, and then you see the Qs and technology suffer as well. And then financials, right? Because on their balance sheets, they're holding a lot of debt, and it's a lot of borrowing and so forth. And then you've got the kind of things that I'm interested in, basic materials and energy, particularly for those commodity super cycles. So where do you want to position yourself? Which country do you want to be in? Which market do you want to be in? And then therefore just break it down in terms of the macro environment. Now, I mentioned to you guys earlier about segment, right? And this can be very different as well, right? So if you take the the oil and gas industry, you've got upstream, midstream, and downstream, and the capital structure and the cost dynamics of each segment is quite different. So if you look at upstream oil and gas, we're talking about big increasing revenue streams because of the upward movement we've seen on West Texas Intermediate and Brent, so crude oil, large project cycle times. You've got the midstream, dependable earnings. We're speaking about pipelines. We're talking about big ticket capex, so reliable, often dividend payers and stuff like that. But a bit different from those upstream oil and gas plays such as Transocean, which is an exploration company to a degree. And then you've got the downstream bit, and you've seen a lot of, I would say, increasing political pressure around asking refineries to refine more crude oil to make that available to, for example, Cuba. There you've got increasing cost inputs, right? Because the feedstock is West Texas Intermediate or Brent. So on one side of the spectrum, you've got boom times for those pioneering exploration firms. But on the other side of the spectrum with the refiners, they're actually getting strangled by those cost inputs and that feedstock. So slightly, well, completely different. And the capital structure will be different, as will be the margins for those industries. So something you need to take into account when you're looking at an enterprise or an equity. So here's some CHAMELEON tools that I use, and I've just given you a bit of a screenshot. Fundamentals, really, really good. And I think Dimitri's been through these, I think, during this week, which was really cool, particularly on the peer comps. I use them a lot. So in the summary bit, and you can click through this as we go along, you've got profit margins and growth rates, which are fundamental to actually understanding what a company is valued at. Those multiples, relative valuation multiples, which we're going to go through in a bit. Peer comps, just having a quick glimpse of the peer group. I'll do some research, I'll find a company, and then I'll place it against a range of other companies just to get a bit of a feel. So same kind of market cap, just to get a bit of a feel how its margins are, with the health of the company in general. Now be careful here, and this is one of the issues with relative valuation multiples. If you have a whole segment which is overvalued, you can go in and say, hey, wait, wow, this is amazing, this is super, super cheap. But if the whole thing is overvalued, then you can make a mistake as well. So that's the important part of looking at those comparables and looking at what's happening in terms of industry dynamics, etc. Then you've got fair value, and these are some of the historical data models which I mentioned. We'll see a little bit later as I share some screens a little later on. And earnings growth, revenue growth. On the revenue growth side, just be very careful of inflationary environments, deflationary pressures, and FX. Now, FX is a perfect example. So we've had, I would say, eye-watering strength in the US dollar. Well, a lot of the, maybe 30 or 40% of the S&P 500 makes most of its earnings internationally, right? So all of a sudden, you've seen forward guidance on losses or FX translation losses because of the strength of the US dollar. So when you're investing in a company, you need to think, where is it making its earnings? Is it making its earnings in the United States? Okay, no problem. There may be some cost pressures in terms of inflation, et cetera, on the inputs. But if it's making all its revenues abroad, and receiving Japanese yen, for example, those are worth less when you've got that eye-watering US dollar. And this one here as well, I spent a lot of time on this. It's pretty cool on the CHAMELEON. I'm going to give props to, and I've said this on the. I've also said this on the pre-market. I use Edgar a lot because it goes into a bit more detail. A lot of the US corporates have to register themselves with the SEC. Really important that you get a kind of a basic grounding in both the income statement, cash flow, and balance sheet. Now, just to give you like a one-liner on each. So income statements, how we determine the quality of earnings, right? How are they, sales quality and earnings quality. Cash flow, we say cash is king. So here we want to look at sources of cash and uses of cash. Cash doesn't really lie, as opposed to, particularly on the income statement, you can kind of manipulate or massage earnings. And then the balance sheet here, we're looking at things such as debt. We're really looking at things, a photo, a snapshot of the company, etc. Its assets, its liabilities, its equity. Use it particularly for things such as debt, its debt load solvency. Also looking out for goodwill, intangibles, things like that. Gremlins which can jump out of the closet and give me a bit of a scare. So here from the CHAMELEON, so I've got just in terms of earnings, right? We spoke about income statement, and I just lined them up here. You can click on your MarketChameleon platform and see all these. And just a basic, overview. If we look at this here, we start off with gross margins, and we kind of go to the right to a degree. It's not exactly correct what I'm saying, but just to give you a bit of an overview. So gross margin, what is it? So it's really net sales minus costs of goods sold. We're looking at profit before deducting sales, general, and admin. So this, like I mentioned down here, the rawest of margin types, right? So it's excluding all costs linked to sales generation, general and admin costs. Now, this can be important, right? Because in more mature companies, they have a lot of overheads. You've got a lot of crystal towers and, executive buildings and stuff like that, and they're top heavy. So more mature organizations can have significant SG&A, and that's something to look out for. So just to understand where your company is in the business life cycle is something which is pretty important. Now, net margin is the next one I'm going to speak about. So as I've written down here, net income generated as a percentage of revenues. We're taking off cost of goods sold, other operating expenses, interest and taxes. Now, be careful here because this is where companies use things such as revenue recognition or intercompany transactions or a whole heap of assumptions to massage numbers. A perfect example could be on considerations for the life of useful assets, how we, so therefore the depreciation, pensions and how pensions are measured. And another example is stock, how inventory is measured. So these can all have an impact on that bottom line in terms of net margin. And that's probably the reason why I don't really look too much at net margin when I'm evaluating a company. I'm probably more interested actually in the operating margin. Now, why is that? Because this is the core business of the company, right? So this is where the company should be making on a sustainable or in a sustainable fashion most of its earnings. So it's stripping out things like divesting assets, one-off sales, stuff like that, extraordinary stuff, and it gives you a bit of a better overview of the core business of the company and how much the company makes on a dollar of sales after paying variable cost, but before interest and tax. And this is the next step, which is EBITDA. Now, a lot of guys say, well, hang on, why am I interested in EBITDA? Well, the answer being, if you're comparing companies in two different geographies or two different markets. For example, if I take a Japanese company and I compare it to an American company, I might think that the margins are better on the Japanese company than the American company, but you need to understand that the reality is Japan's got 2.5% inflation right now. It's got full employment as well, but it's got a weakened currency, whereas the States has got 8.1%. It's got an economy which is rolling over. It's got tightening monetary policy. These things are completely different. Now, EBITDA is stripping out interest expense on debt, effectively tax, because tax regimes are different. If you look at the Nordics, Scandinavian countries, we're talking about 50% corporation tax. If you're talking about Singapore, for example, you're talking about 15%. So there's a huge difference there. And things like depreciation and amortization. Now, this is really important. I'm just doing my little drawing here in terms of, let's put it here. You think I'm crazy, but weighted average cost of capital, it's the mix of debt plus equity in the capital structure of a company. Now, what's important to know here is that in high tax countries, they have a tendency to raise more debt. And the reason being is debt acts as a tax shield. And therefore, the optimal use or the optimal balance of debt and equity is often different in a high tax country as opposed to a low one. So countries such as the Nordics, they may have a higher debt, a higher debt burden than a country which has lower taxation. And when you look at this and when you're comparing companies, you think, well, there's some huge differences there. You need to take into account those markets, that country risk, which I mentioned to you earlier. And EBITDA kind of flatlines that. It gives you it gets rid of things like, considerations around useful life of assets and debt and fiscal burdens, which are linked to either a country or even a government. So here we're going on to the fundamentals, and we're speaking about relative valuation. Really simple stuff here, just to give you a bit of an intro. P ratios, I'm sure you've all heard of them, and I'm sure you've seen them on TV and stuff like that. When you're looking at them, you're looking really at least at next 12 months over the last 12 months. Now, what do I mean by that? Is that when we're kind of pricing equity and we're taking a position in a risky asset, we're looking really into the future, right? So looking at the last 12 months might give you a bit of an idea where the company's been, but you're going to be rewarded in terms of positive risk-adjusted returns on the future. So it's really important to look at that next 12 months and get a gauge. So we're speaking about price over earnings per share. Now you say to yourself, well, hang on, some companies don't have earnings, right? And I'm thinking about those stonks, right? The high growth, lofty companies where they've got a lot of, story stocks or whatever, a lot of followings and stuff. Well, no point really in putting them through a PE ratio because it's going to come out with garbage. Garbage in, garbage out. And that's why we use something else. Now, be careful again, like I mentioned to you, whole asset classes can be overvalued and it can give you a mistaken impression that, wow, you're getting a discount or it's really expensive. And that may not be the case given the sum of the basket of risky assets. Now, when we're speaking about stonks, those crazy companies such as SPACs, fledgling firms, things with no earnings, there's a big story behind them, there's an amazing founder or whatever, then we're going to look at price to sales. And why is that? Well, because not all companies have earnings, particularly companies which start out, they spend several years making losses, right? But almost all companies have some form of revenue, some form of sales. So here we're looking at how much investors pay per dollar unit of sales. And it's ideal for firms with no earnings, like I mentioned, fledgling firms, technology plays, which have got really, pioneering kinds of ideas, etc., and that we spoke about SPACs and speculative kinds of positions. Price to book is useful for companies with lots of assets, right? So we're speaking about things like real estate investment trusts, could be big pipeline plays, or even certain financials where you've got a lot of corporate debt and a lot of borrowings and stuff like that. Here you're going to actually look at the book value of the assets, and then bringing it back down to different countries. If we want to compare one country to the other, Then we're going to look at EBITDA, because why? We're going to strip away those considerations around interest, tax, depreciation, and amortization. Interest because of the debt load, tax because of the tax regime in the country may be different. Thinking about, for example, Norway as opposed to Singapore, and then depreciation, amortization. Different companies have different policies around useful life of assets and stuff like that. So really important to, when you're valuing a company, to know which bucket to put it in. What kind of company am I speaking about? Am I speaking about a company which is very mature in its business, business life cycle? Or am I speaking about something which is, brand new, it's going to be the trend for years to come, etc.? You got to put it in the right bucket, otherwise you will get the wrong information. So I'm just going to dial into a couple of examples here. So let me just show you a few and show you some of how I do my research on the Discord. So that's something that I run, and you're all welcome to join and just read and participate or whatever. I'm just going to try and swap screens. Tell me if you see it, guys. Otherwise, I'm going to have to turn on and off. Can you see my Discord there?
It's showing up still as your black screen, a few Discord examples. So it hasn't moved over to the Discord channel.
Okay, I'm going to stop sharing, and then I'm going to just dial it up again. So we're speaking about Zim first.
I will put, while Jake's doing that, I am going to put the link to the Discord both in YouTube and on the Zoom. That is something that the doctor runs. He created. It's way more than just Market Chameleon. He does a great job and is very insightful on that channel. And there are a lot of both chameleons and followers of the doctor who are on the Discord channel. So it's a great channel.
You see my little Discord there?
Yep, it's up now, Jake.
Okay, so I'll give you a little bit of example, and I publish all my research on the channel. I'm normally on the trading floor. I actually have my own channel, which is just for me, where I do my own macro research. Another one is the education channel, where I put in a lot of work and detail, on different things around options or even around valuation, where you can go and dial in. So here, like I spoke about Zim, I'll just show you how I do it. So basically, you start off with a narrative, right? So I've just put it here. If you're a believer that China lockdowns will progressively subside and international trade will pick up, then Zim may be something worth looking at. So first thing here, DuPont analysis. We're looking at return on assets, equity, total capital. And I've highlighted really for you guys to have a look at how that's evolved over the past period. We're speaking about 1.2 times forward earnings. So this thing is pretty cheap, but you need to look at the basket of assets in general. So I go on, right? And I've written it here, 1.2 times forward PE multiple on a cash machine, but big risk also prevails. International trades collapsed. Remember, we had that post-pandemic boom where we had container rates, 20-foot equivalent units at about $20,000, and we're down now at about $6,000 and rolling over, because we've had guidance from Target and Walmart and retailers where they've said, hey guys, we've got too much inventory timeout, and that's going to have an input or an effect on container rates as well. So I click on here, and you've got all sorts of earnings multiples here, and you see how it's depleted from about 5 times earnings in 21, where we had that $20,000 container boom, to about 1.2. And then I go straight onto the Chameleon, and I'm finding out about the company. So it's an asset-light container shipping company, does out-of-gauge cargo, refrigerated, dangerous and hazardous cargo. Now here, very interestingly, revenue from the Pacific. Now, this as well is really important, because my shipping company, I want to know, is it diversified in terms of its revenues? And it's not, right? So this essentially is a play on trade between China and the United States. And we've got 2 big risks here, huge risks. We've got the COVID lockdowns on the east coast of China. And then we've also got in the United States, we've got, a lot of union movement around the ports and bottlenecking of the ports, while we thrash out trade deals and stuff like that with labor groups, etc. So there are 2 big risks. Another thing I look at is ETF exposure. If this thing has got a lot of ETF exposure, then I know it's probably going to get a lot of support as well. So I go on, and here's a perfect snapshot of that valuation table straight off the Market Chameleon. And I've highlighted, on a 3-year average, this thing's trading at about 4 times earnings. It's right down at 1 right now. Price to sales as well. It compares it against SPY. And then price to book. Now, shipping companies generally have a lot of assets because they've got a lot of container ships and stuff like that, or container freight. Then what I'll do is on the Chameleon, I'll put it against a basket of peers, because I want to know against its peer group how this company's going. Now, the first thing you do on the Chameleon when you choose your basket of peers, you want a similar capital structure, right? So I don't want to put this against a company which has got a market cap of $50 billion, because the revenues and the, how would I put it, the dynamics in terms of costs and balance sheet and income statement may be completely different. So I'm trying to compare it to something which is comparable. And then I've highlighted here for you guys. Gross profit, 60%, operating income, 58%, net income to shareholders, 45%. So based here against a comparable group within the same asset class, company's not doing too bad. But hang on, risks prevail, right? So whenever you're doing your research, always think of the risk first before the reward. And here we go. When we look at the history of the company, it's been banged up, right? So we had a decline in shipping. It's kind of rolled over post-pandemic, and this thing has been beaten up for the last 3 months. So if you want to go in, you're going to go in with a degree of pain and a real degree of risk. It's done okay over 1 year, but year to date, it's been pretty lackluster. Right? And then we get on to the valuation multiples. And here on El Chameleon again, this is a great screen. I use this all the time. And when I post on the Discord, I'll highlight what I'm talking about, right? So here, look at, we were talking about, I think, maybe 40, 50% margins against 30%. This thing is 1/3 the price of its basket of peers on a basic P ratio. But again, cash is king, right? So here I'm looking at, price to cash flow from operations. I'm speaking about the core business. And this thing here is less than 1 times. 1x against 3x and 2x, we drive up again. So it's been beaten up. Let's just go back to where we were on something which has got 60% margins against a peer basket which has got 30% margin. So again, this is not where you make a decision, but it is where you want to find out more. So this is where you might go to Edgar, you might go read through the annual report, find out who's on the board of directors, the capital structure. You got to go into a bit more detail, but the Chameleon's a perfect way of just getting into that detail, and even the Discord as well, because I throw out ideas and stuff and get feedback and stuff like that. So there is Zim. Let's have a look at another one. Sorry, where's my... I'm just going to find it as we go along. Okay. Bear with me. Okay, new search. So let me just dial through some others. We've got some jokers. So I put a lot of stuff. Another one is insider transactions. I'm going to try and find Medifast. Okay, here's one. So which I've identified, and you've got this on the Market Chameleon as well. Got a lot of insider buying on Occidental Petroleum. For energy bulls, that's me. I'm going to go look at momentum and then straight on into the valuation again. So we're looking at balance sheet, we're looking at return on assets, equity, and I kind of just give you a bit of an overview. You can click on it and it gives you a bit of an overview of what's changed with that company. I comment that as well, and then straight onto the Chameleon. Look at the basics, right? We're looking at volatility, we're looking at earnings coming up. You can see some earnings coming up here. And then again, straight onto the Chameleon, I'm going to compare it to its basket of peers. So we're looking at Pioneer, we're looking at Canada, I think this is Canada, etc., and looking at the revenue streams and stuff like that. So, and I highlight where this thing, Occidental Petroleum's operating income's less, but then I'll try and compare it to the price action. We've seen Warren Buffett continue to buy and continue to support the stock, and you've seen that in the price action component as compared to the basket of peers. And then looking at the valuations as well. So I put pretty much everything on here in terms of, the research I do. And that gives you guys an overview of, how I work and how I do my research. So here's another example where I'm looking at, year-to-date returns on different asset classes. And I see that healthcare has been really beaten up. So the next thing I do is I'm going to develop a bit of a spreadsheet and then go and look at different things in terms of returns on assets, equity, invested capital, etc. And then I'll share that. Now, normally, I don't know how I can do. Normally, I've got a screen here where I can actually do searches, but I don't seem to be able to do it today. Here we go. Just bear with me, guys. I'm just going to go freestyle. I did some. Okay. So I did quite a bit of work and research work on lithium. And I'm just going to find that for you as we go along. Here we go. So I did a lot of research work on lithium plays. So you've got American gigafactories, you've got, the requirement in terms of lithium, etc. Then I break it down, do my own little spreadsheet, use data out of the Chameleon and other sources. And I've got my country risk, my market cap, year-to-date returns. Here's a perfect example. We've got forward 21-year sales on lithium companies. These are fledgling plays, so they don't have any earnings, highly speculative and highly risky. From there, I'm going to start looking at the bigger ones, where they're from, so country risk, right, their market cap, etc., etc. Breaking that down, and then I go into a bit more detail. Excuse me. And so they're just some of the ideas of, how I use my research, I use the Chameleon, I share that on the Discord in general, and just a bit of an overview on how you select equities based on a macro approach, bringing it down to a country, an asset class, and then a company based on a whole heap of fundamentals. I think that's pretty much it for the day.
Well, that was awesome, Doctor. We had a question from
Sure.
one of the Zoomers. He was asking about a few. Let me try to get that up. There it is. He was asking about some of the valuation ratios. He said, "Great content, Jake. Could you please at the end tell what are your favorite KPIs? What do you think about cash is king? And for mature companies, I guess FCF percent, that's free cash flow of sales, I'm assuming, would be one of the most important metrics."
Yeah, so to answer your question, you kind of start off, you've got to identify the company. Where is it in its life cycle? Is it a very young company? No point going to PE multiples, go straight to price to sales. But generally right now in this current market environment, I'm looking, as you mentioned, cash is king. So I'm looking at things such as free cash flow. So free cash flow to the firm, free cash flow to equity, etc. Discounting those future cash flows and then trying to understand the net present value. So stuff which is the third type. So you've got relative, you've got absolute valuation multiples, and then cash flow multiples. And as you mentioned, cash is king at this moment.
Awesome. I had one question. When you dug deeper into OXI, I mean, I should probably go to the Discord and read. Was your conclusion that Buffett's making a wise choice? I mean, it looks like he's paying up relative to the basket of peers. Am I incorrect? Or
yeah,
what
look,
are your
well, my thoughts, so this is kind of a bit of a front running idea, really. So this is not something I would like buy equity in and just hold. This is kind of, look, you look at insiders and insider transactions. Now, when you've got that kind of money, you got a lot of support to the stock. Remember, we're speaking about energy here, right? So we're in an environment which is where West Texas Intermediate, I think it's about $95 a barrel, went all the way up to 120. There isn't really much in terms of a lot of investment in oil players in future development. So the reality is, if, for example, China came back online and they started, easing up on lockdowns and stuff, then all of a sudden you're going to find more upwards pressure on oil prices. So I look at that, and then for this one specifically, I can speak about this one. I then used this is a real thing. So I did that, looked at who's front running. It's Warren Buffett. Look, this guy knows a lot more about valuations and managing risky assets than me. I see a lot of support. I look at whether the company's making money, etc. It's more or less there. And then something like a risk reversal is something that I actually put on, but I would hold that very short term. It's not something that I would put in my basket of risky assets for the long term. An example that you've got on the Discord, which I wanted to show you, but I can't find it there, is New Hope Coal. And I do own and hold equity in that. And it's an Australian play. Coal is not dead, I don't think. I'm a guy from the energy industry. I think we've gone, I think the solution to the energy mix is diversification. But there still is a chunk of people, particularly in emerging markets, India, Southeast Asia, that still rely on cheap, dirty energy per se. And coal prices, Newcastle coal's at record prices. We're at $400 a ton from maybe $150. So you see this reflected in a lot of the earnings and stuff like that. So if you go on the Discord and go into the search bar, then you can look up NHC and you'll find all my research on NHC. And I even say there, look, I'm buying this stock and these are the reasons I'm buying it. And sometimes guys will say, no, I disagree, or sometimes I'll agree. It doesn't matter. Like, this is my own research, and it's great when people get online and share their stuff for whatever reasons that may be. Here's a good example here. So I've just given you the price action on an ETF for Egypt. Now, if you look at Egypt, it is, I think, the number one consumer of wheat in the world, right? And we're in a crisis in terms of food supplies and foodstuffs, particularly out of, the Caspian, because of the conflict in Ukraine and Russia. We've had wheat prices go through the roof. In terms of the capital structure of the country, they're on a risky patch in terms of going bankrupt. So this is where you think, well, do I short, Egypt? So this is how you develop ideas. You link them all to macroeconomic phenomena per se. So I put all that on the Discord. By all means, guys, go on, read whatever you want. Even, dial me up and say, hey, what do you think? I'll give you my opinion. I'm not right. I'm not, I give my opinion based on my experience and so forth. But again, and as Will mentioned, really important that you manage your own risk. and you do your own due diligence and your homework. This year, particularly the Discord, is all about sharing ideas, sharing and learning about the Market Chameleon, and having a bit of fun. With a bit of a friend. The Chameleon community in general, I've found, is pretty cool and pretty laid back and pretty friendly in general.
I would agree. Last question is about valuating companies with negative cash flow. I know you mentioned price to sales, but they're asking tech companies, 3 years of operations, no negative cash flow. How do you even look at something like that, particularly in a rising interest rate environment?
Yeah, so super difficult, right? Because again, in a raising rate environment, you're going to have difficulty in terms of recourse to equity, private equity, or even debt. So that makes it kind of more difficult. Me, basically, I just go straight on to price to sales. But I've got to admit right now, in terms of my holdings, I'm pretty much holding nothing, I think, related to tech. So me, I'm pretty heavy on energy and commodities because I've worked my whole career in that space, and I share a lot of my experience having worked, in whether it's in mining or in oil and gas in regards to that. But I haven't got anything in terms of tech because of the interest rate environment. Very difficult to do. You can try and find a comparable. It's very often difficult because these are heavily innovative firms. So then you can go back on price to sales. You can also go through the guidance, but what happens is boards tend to, sugarcoat their earnings potential. So it really, and also then you can try and link it to a technology, right? And that's the important part of getting involved. For example, Zim is a perfect example. Well, this is a shipping firm. So the first thing I did was I went on to dialed into a professional webinar on container rates and container freight rates, and sat through that. It was about an hour, and they spoke about the evolution. It's very cyclical, actually. Shipping containers, like you have a bit of a lull in the mid part of the year, and then as Christmas approaches, particularly in the States, you have a run, right? And then air freight lags because air freight's obviously quicker. Now that's going to change. Where we went from post-pandemic at $20,000 per 20-foot equivalent unit all the way down to $6,000 right now. That's how I value a tech firm. I try and understand what they're doing. I'd read a lot of their guidance. I put it through the price to sales kind of thing. I definitely do my homework, particularly in this kind of environment. For me, super speculative, but we're all different, right? We all have different risk profiles, risk appetites, etc. It could be a winner, and the important thing is you do your research. And so possibly going onto the Discord and looking how I do it, it's not the right answer, but maybe it might inspire you to do something differently or whatever, or even challenge ideas that I have around a position, a market, or whatever.
That's great, Doctor. You gave us an extra 15 minutes of your time. That's much appreciated. Thanks for joining us, Jake.
Thanks. I really enjoyed that, guys, and hope to catch you on the Discord or even on the pre-market show. Thanks, Will and Dimitri, for having me along.
Excellent. For those who don't know, we have a pre-market show live every morning, 9 a.m. Eastern time. That's U.S. Eastern time. It streams on our YouTube channel, on the MarketChameleon.com website. You can check it out there. Great job, Jake. Everyone, thanks for joining us. You have a great end to the trading day. We've got about 15 minutes left here in the States, Jake. Have a safe